In 2022, big tech said layoffs were temporary. In 2023, they said it was about efficiency. In 2024, profits rebounded. In 2025, AI investment hit record highs, and yet the layoffs didn't stop. Meta is highly profitable again. Microsoft is breaking revenue records. Alphabet is generating over $300 billion a year. So why are thousands of jobs still disappearing? If this were just a crisis, layoffs would stop when profits recover, but they haven't. And that tells us something deeper is happening. In this video, we'll break down why the pandemic overhiring story is incomplete, why markets reprice tech growth, why AI investment is replacing labor investment, and why layoffs are becoming structural, not cyclical, because this isn't a downturn, it's a capital transformation. Let's start with what everyone already knows. Between 2020 and 2022, tech companies hired aggressively. Meta added around 43,000 employees in 2 years, bringing total headcount near 87,000 by late 2022. Amazon nearly doubled parts of its corporate workforce. Microsoft's headcount grew from about 144,000 employees in 2019 to over 220,000 by 2022. Why? Lockdowns accelerated digital demand. E-commerce, cloud computing, online advertising, remote collaboration. Revenue exploded. Companies hired as if the future would grow at 30% forever. But when the pandemic boom normalized, cost structures were simply too large. So in 2022 and 2023, layoffs felt logical. A correction, a hangover after the party. That was cyclical. But if the story stopped there, layoffs should have slowed once profitability returned. They didn't, and that's the clue. Here's the uncomfortable part. By 2024, Meta's operating margin recovered above 35%, up from roughly 25% in 2022. Microsoft surpassed $211 billion in annual revenue. Alphabet generated over $300 billion in revenue. Stock prices rebounded strongly. This wasn't a collapse. It wasn't 2008. It wasn't a tech winter. And yet, layoffs continued. So what changed? Not the companies. The markets. In 2022, interest rates rose aggressively after more than a decade of cheap money. Capital suddenly had a cost. And when capital has a cost, future earnings become less valuable. You can see it in forward PE ratios, basically how much investors are willing to pay today for tomorrow's growth. Across software stocks, forward PE multiples compressed sharply. Investors weren't saying tech was dead. They were saying future growth is less certain and more expensive. When tomorrow becomes less valuable, companies get defensive today. They protect margins. They conserve cash. They increase capital efficiency. And payroll is the largest controllable cost. But this isn't just a SaaS story. Even Apple, the ultimate cash machine, is no longer accelerating the way it once did. iPhone growth has plateaued. Services growth has normalized. When even the most reliable engine slows, you know the environment has changed. The era of effortless hypergrowth is ending. And when growth becomes scarcer, capital becomes selective. That affects hiring decisions across the entire sector. Now look at capital expenditure. Microsoft's capital spending is projected to exceed $80 billion, largely driven by AI infrastructure. Alphabet is spending more than $50 billion a year on data centers. Meta is investing tens of billions into AI compute clusters. This isn't incremental spending, this is an arms race. But here's something even more important. Software used to be untouchable. Gross margins between 70% and 90%. Absurdly profitable. That margin cushion allowed companies to hire aggressively, even before profits materialized. But that cushion is shrinking. AI infrastructure is expensive. Cloud compute costs are rising. Pricing power is under pressure. As companies integrate AI features, their cost base increases. Across parts of the software sector, gross margins have compressed into the 60% range, sometimes lower. When margins tighten and AI costs explode, something has to give. And payroll is the easiest lever. Every dollar spent on GPUs is a dollar not spent on headcount. That's not recession. That's capital substitution. From human capital to machine capital. And here's where it gets even more structural. Investors aren't just worried about costs, they're worried the product itself might change. If AI can write code, if it can automate workflows, if it can generate internal tools on demand, what happens to traditional software subscriptions? In early 2026, software stocks fell sharply again, not because revenues collapsed, but because investors feared pricing power could weaken. Big tech is facing double pressure. Invest massively in AI. Protect margins in case AI disrupts your own business model. The rational response? Cut labor, increase capital intensity. That's structural. Here's the deeper capital story. Profits are strong, but labor isn't necessarily capturing the upside. Tech companies are allocating more capital toward data centers, chips, model training, infrastructure, and less toward expanding headcount. Capital is scaling. Labor isn't, even as revenues grow. That's the paradox. Profits no longer guarantee employment growth because productivity gains from AI reduce the marginal need for labor. This is what technological transition looks like. If this were a recession story, layoffs would reverse when profits recover. But profits have recovered. Investment is exploding. Stock prices are strong. And yet hiring remains cautious. That tells us this isn't a temporary correction. Big tech isn't shrinking, it's transforming. From scaling teams to scaling machines. From hiring waves to infrastructure waves. The real question isn't why they're firing people. The real question is what happens to white-collar labor when intelligence becomes infrastructure. That's not a cycle. That's a new equilibrium. And that's how capital works.